Ladies and gentlemen, good day and welcome to Seamec Limited Q2 FY26 conference call hosted by Arihant Capital Market Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Balasubramaniam. Thank you, and over to you, sir.
Thank you, Krishna. Good afternoon, everyone. On behalf of Arihant Capital, I welcome you to the earnings call of Seamec Limited for Q2 FY26. From the management side, today we have Mr. Rajiv Goyal, Non-Executive Director, Mr. Vinay Kumar Agarwal, CFO, and Mr. Sunil Gupta, Vice President, Strategy and Investor Relations. We welcome the management of Seamec on this call. Now I invite Mr. Rajiv Goyal, Non-Executive Director, to give his opening remarks, following which we will open the floor for Q&A. Over to you, sir.
So, good morning all. I am Rajiv Goyal. I am Non-Executive Director for Seamec. And I would like to extend a warm welcome to all of you to Seamec Q2 and H1 FY26 earnings call. And I really thank you for taking the time to join us today. I am joined on this call by our Chief Financial Officer, Mr. Vinay Agarwal, and our Vice President, Strategy and Investor Relations, Mr. Sunil Gupta. Both are veterans in their field and very experienced. I would like to highlight here that the Indian petroleum and energy sector is undergoing a transformative expansion, poised to play a defining role in shaping the global energy future, India's, this journey. And this India's energy journey has reflected till date a remarkable progress, which is driven by the visionary policy, rapid innovation, and sustained investments across various sectors of refining, biofuel, and green energy, all undertaken by this Government of India and our Ministry of Petroleum and Natural Gas under the leadership of Mr. Hardeep Singh Puri, our Union Minister. As of now, our capacity stands at about 258 million metric tons per annum, and we are on track to reach 310 metric tons by 2030, with long-term plans to scale it further. As said, this expansion will consolidate India's position among the top 3 refining hubs globally, as around 20% of the existing global refinery capacity faces potential closure by 2035. So while the global energy market is expected to grow at a slow pace with several refineries worldwide facing closure, India stands out as a bright spot, projected to increase its contribution to nearly 33% of global energy demand in the coming decade. As far as Seamec was concerned, so this was a very challenging quarter for us, being the monsoon quarter, as we all call it very fondly. And this is a period when majority of our vessels, they are unable to work because of the weather, and there were restrictions on their deployment. Coupled with that, we also faced some operational headwinds, especially with regard to our vessels, Swordfish. And we have discussed about Swordfish in the previous investor calls also. Unfortunately, this vessel experienced a technical breakdown in mid-August after having successfully, deployed with the Aramco, and which impacted its availability of charter hire. But as of now, all those defects are duly rectified, and the vessel is in the field and is fully operational. Further, I am pleased to announce that our barge Seamec Glorious has entered into a firm charter party with L&T for work in the Mumbai High and Western Offshore region for a firm period of 150 days. And this barge is already mobilized in the field with L&T. We have also secured a charter hire agreement worth 6.3 crores with Head Offshore for the charter of its vessel Goodman. The company signed a memorandum of understanding with the DG Shipping to invest approximately almost 1,000 crores in our maritime business. Monsoon seasonality continues to be a factor in the offshore segment, impacting mobilization and chartering activity. However, given the new contract secured, we expect the operations to improve as the chartering activity picks up and monsoon impact fades. The next few quarters will be very meaningful to us as we capitalize on the upcycle and continue strengthening our foundation for sustainable growth. Thank you for your time and continued trust. I would now hand over the floor to Mr. Vinay Agarwal, our CFO, who will provide you a detailed overview of our financial performance for Q2 and H1 FY26. Thank you very much.
Good afternoon, everyone. Thank you, Rajiv. I warmly welcome everyone participating in today's Q2 and H1 FY26 earnings call. Allow me to walk you through the standalone and consolidated financial performance for the second quarter and first half of FY26. Our consolidated top line for the quarter stood at INR 108 crores compared to INR 110 crores in Q2 FY25, reflecting a 3% decline year-on-year basis. At the standalone basis, revenue stood at INR 91 crores versus INR 102 crores in same period previous year. For H1 FY26, our revenue at Concall level stood at INR 338 crores compared to INR 333 crores in H1 FY25, up by 2%. At the standalone level, H1 FY26 resulted in revenue of INR 314 crores versus INR 320 crores in the first half of last year, a 3% decline. EBITDA for the quarter at Concall level was INR 18 crores in Q2 FY26 against INR 38 crores in Q2 FY25. On a standalone basis, EBITDA stood at INR 9 crores in Q2 FY26 compared to INR 37 crores in Q2 FY25. Consolidated EBITDA for H1 FY26 stood at INR 135 crores versus INR 119 crores in H1 FY25. At the standalone level, EBITDA was INR 125 crores in H1 26 against INR 123 crores in H1 FY25. Decline in performance was happened mainly due to unscheduled breakdown of our vessel Seamec Swordfish during the current quarter, which now is perfectly alright and it is working in the field. As on consolidated basis resulted in a loss of INR 26 crores compared to profit of INR 0.2 crores in the same quarter of the previous year. On a standalone basis, loss was INR 26 crores in Q2 FY26 versus profit of INR 3 crores in Q2 FY25. H1 FY26 resulted in the PAT of INR 50 crores, same as in H1 FY25 at the consolidated level. PAT at the standalone level was INR 54 crores in H1 FY26 against INR 55 crores in H1 FY25. Both the ROCE and ROE stood at 8% at the consolidated level. Thank you for your continued support. With all our fleet up and running now, we are confident to get back on track in the upcoming quarter. Now I would like to open the floor for question and answer. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Abu Rafi, who is an individual investor. Please go ahead.
Thank you for giving me the opportunity. I have few questions. In recent quarters, there appears to be an increase in the frequency of vessel breakdowns. Could you please elaborate on the management strategy and action plan to minimize such occurrences and ensure faster resolution when breakdowns do occur?
You have more questions or we answer one by one?
One by one would be better, sir, for me.
Sure. As we have been guiding the investors, some of our vessels are already quite old. Okay. And with the age, the breakdown is quite possible. We are adding newer vessels to the fleet, which is one solution. Secondly, we are doing higher focus on the preventive maintenance. And third, we are also taking care of keeping some spares which can help reducing the downtime. I hope I answered your question.
Okay, all right. So my next question is, in your previous concalls, you have mentioned that there's a lot of work available in the market, but we don't have enough vessels to meet the demand. So I wanted to understand, can't we just lease the vessels from other companies and get the work done? Is it not possible for us?
Rajeev, I would like to answer.
Thank you for your question. So, leasing vessels from other companies and then, adding my services to that vessel and then further giving to the customer is not financially feasible. Because, see, please understand, so this is a capex business, when you go for charter hire of a vessel, there are so many conditions involved to that, especially as you just mentioned regarding the breakdown and maintenance of the vessel, right? So we have to ensure that we get a very good vessel with a good track record of being in the field, and then the lease charges have to be financially feasible. And our experience here has been that whenever we have tried this experiment, at the end of the contract, after taking into account all contingencies and everything, the returns are not so attractive to really, outweigh the effort that we put in such contracts. And as of now, I'm very happy to say that, almost the entire fleet is working in the field, fully operational. And yes, we are always looking out for increasing our fleet size, considering the demand options that we have at our disposal. Thank you.
All right.
One thing to add, Rajeev mentioned. See, we had almost done a capex of 500 crores about 2-3 years back. Okay. This year we have again committed 800 crores for expansion of our fleet. So this is an ongoing journey, and we will make sure that the cash flows and the opportunities are aligned in a manner that we don't miss out on opportunities. Okay?
Okay, all right. So one last question from my side, and I'll join the queue back. So when can we expect the delivery of Anand?
Rajeev ji?
So in Anand, we have got finally the shareholder approval for the RPT transaction that e-voting just got concluded on 31st of October. And now, the further process of approvals from DG Shipping, ONGC, we can approach them. And as of now, our plan is to mobilize it by 1st of Feb. And that is what is also part of our financial budget. And we are looking forward to meet the timeline.
Okay, all right. Thank you, sir. Thank you very much.
Thank you. The next question comes from the line of Manar Rao from Orbit Capital. Please go ahead.
Yeah, hi sir. Am I audible? Good afternoon. Am I audible?
Yes, you're audible, sir.
Yes, yeah. Okay. So my question is, sir, Seamec spot phase was almost operational for about 75 days in this quarter. And then we also had Seamec Palladium almost operational for the entire quarter. So if I just take the revenue of these two on a standalone basis, it should have been 80 crores. On top of that, I had Princess, Diamond, and even Seamec 2 was operational for some point of time. So how come, we have done only 82 crores on a standalone basis for this quarter? Because as per me, just these two ships, Swordfish and Palladium, should have, sufficed that revenue which we have done this quarter.
Request Vinay to answer this.
Whatever you are saying, sir, in case of Swordfish and in case of Palladium, we have worked for full quarter, but in case of Swordfish, we have worked only for 21, 22 odd days. So, revenue is not sufficient, whatever you are saying. Whatever we have reported is as per the deployment chart of our vessel. And you are right in saying that had we would have deployed this vessel for the entire quarter, revenue would have been much better. But Swordfish was deployed only for 22 days. And Palladium,
sorry to cut in between. Actually, we had only a notification that August 28th till 12th September, Swordfish was not deployed. So how come only 22 days, sir? Even if I remove, from 28th August to 12th September, which is about 15 days from 90 days, from my calculation, it comes about 75 days.
No.
So
I would like to add just one thing. In this quarter, we have started our deployment for Swordfish effective around 14th or 15th of August. And it remained on hire for 3-4 days, then went off hire due to some breakdown, then again redeployed somewhere around 10th or 12th September and worked till quarter end. So effectively, this Swordfish has worked 22. There may be some calculation error on your part, but this is how.
No, got it, sir. Just a follow-up on this, Seamec Swordfish, the contract was supposed to start from May of 2022, and this is a 730 days contract. So, sir, just to understand, is this a continuous contract? Because why did we just deploy it from August? I mean,
you are right in saying this Swordfish was supposed to be deployed from May, effectively April 2025. Due to certain visa issues which we have already notified to the exchanges and in our investors call to all the investors, due to certain visa restrictions by Saudi government, we could not deploy it for quite some time, say by July. Then after there are certain operational issues, there are a huge lineup of visa seekers. Then finally we deployed our vessel effective August 2025, and it's a long-term contract of 2 years with Safian, and it will work for 2 years. Effective, we will need to complete 2 years period of 734 days. So we will continue and we will complete that contract.
Got it. Sir, my second question is, last year the barge, it was almost the day rate was coming at $75,000 and this time it is almost $22,000 per day. And I'm not exactly quoting the price, but it is almost 1/3 of what we contracted last year, the Seamec Larius. Okay. So why did this happen, sir? Why such a big drop?
So, sir, in case of Glorious, whatever you are saying is partly right. This year we have contracted our Glorious only on charter day rate basis, and we have not added any other services. Earlier, whenever we are working with ONGC, this includes diving services as well, which incur huge costs. So both the contracts are not comparable at all. In this contract, which we have entered with L&T, we are providing only barge along with crew. That's it. So this is the difference.
Okay. All right. Sir, another last question from my side before joining the queue. On a year-on-year basis, if I compare both H1 of this year and H1 of last year, our employee cost is up by 25%, and even this quarter on an operational cost basis, we have incurred a lot of costs. So I just wanted to understand, despite revenue almost being flat, why are the employee costs increasing at such a rapid pace? Almost 25% is the increase if we compare H1 of this year to H1 of last year.
Sir, if you look at the numbers, when we say employee cost in our case, This includes through cost or through deployed at the vessel. So in this quarter, we have added Seamec swordfish in our fleet. Earlier, this was not there. Crew was deployed on the vessel, so it was not earning revenue. So when you compare revenue, there is no growth in the revenue, but vessel is up and running from crew perspective. So we have incurred cost on crew, hence the overall cost has gone up.
Okay. So we have the employees, but the deployment was not there, hence the cost has gone up.
Right.
Is that right understanding, sir?
Crew was there on the vessel swordfish, but due to breakdown, it couldn't perform. So revenue was right.
You are right.
Got it. Sir, really sorry, just one last. In Q1, we didn't have any revenue from swordfish. My understanding is right. Correct. Quarter one of this financial year, we didn't do any revenue from swordfish because you are telling it is deployed from August.
Sir, in the initial period of, say, May, there was a small revenue. There was mobilization revenue and some 10 odd days of revenue during May. So there was few revenue.
Okay. Got it, sir. I'll join the queue. Thank you so much.
Please. Thank you.
Thank you. The next question comes from the line of Tejas, who is an individual investor. Please go ahead.
Yeah, good afternoon, sir. Thank you for the opportunity. Just one question is that since we have these breakups and breakdowns on the site, as a part of a contract, do we also have some penalty incorporated, or is only just the loss of revenue that we have to incur?
Rajeev ji?
Mr. Tejas, thank you for your question. So, when we plan and make the budgets for a particular charter hire contract, so we do take into account the budget for maintenance, and definitely if the vessel is not operating, we lose that particular period of charter hire from the customer. In case of ONGC, if that breakdown is, there's a clause which says that further penalties are applicable, and if these breakdowns are due to vessel or due to the outside services, accordingly they are apportioned in the books of accounts. So yes, penalties are there, but accordingly the same are also part of our budget. The only issue that we really face is when these breakdowns are like unplanned or there's some accident or something like that. That is where we actually incur loss.
And so, as I understand, sir, these penalties are not part of every contract. It will differ from contract to contract. Is that a good understanding?
Yes. It all depends on contract to contract. So, primarily it is the loss of revenue when the vessel is not working. However, in the case of ONGC, the contract says application of penalties also.
And what was the rough percentage of this penalty, sir? Give a very...
It all depends. When we calculate the breakdown, so we calculate it on hourly basis, right?
Okay.
So if out of 24 hours, if the vessel is not working even for 6 hours, and what is the type of breakdown? Accordingly, the penalty varies from, say, 20% of charter hire to up to almost 2.5 times of the charter hire. So there are flags, there are detailed information that what breakdown constitutes a major breakdown, a minor breakdown, or a vessel not fully operational. All those are part of the confidential agreement that we have done with the ONGC, but we are also accounting for it.
Okay. Sir, the last question from my end is, there was a doubtful allowance in your of 140 crores. Any status on that? Are we receiving it? Are we taking any action on that? Is it clear or is still pending, sir?
Request Vinny to please answer.
Okay. Sir, you are referring 140 odd crores, right?
That's correct. 140.38 crores. Yes, sir.
This pertains to year 15-16, and this pertains to fiber. We have already fully provided, and there are less chances to require anything, but no more impact will be seen in our financials. Everything has been provided.
Okay. Thank you so much. Okay, sir. That's all from my side. Thank you.
Thank you. The next question comes from the line of Keshav Garg from Counter Cycle PMS. Please go ahead.
Sir, I wanted to understand that if we see pre-COVID, our margins used to be less than 20%. I'm talking from 2014 to 18. But sir, post-COVID, the margins have been above 30%, around 35%. So what is the reason for this? Is it because the rates have gone up, the charter rates have gone up? Is that the reason or there is something else?
Keshav, there are two reasons. Yes, the charter rates have gone up. Secondly, the mix of the business has also changed. So there are two kind of businesses we do. One is EPC contracts and other is IMR contracts. The ratio of IMR contracts is going up where there is higher margin business. And this is our focus as a strategy also.
And also, we have upgraded the age of our vessel. So we have got 4 relatively young vessels as compared to the vessels we were operating in the period 2015 to 2018. And because young vessels have lesser repair and maintenance as compared to old vessels, that is also one of the factors that has contributed to this.
Sir, so now to the extent that the margins have gone up due to the higher charter rates, sir, so now when the charter rates are higher, I am assuming the new vessel cost would also be higher and vice versa. So the ideal time to expand the fleet is when the charter higher rates are very low, so that the capital cost is also low and the cost of acquisition is low and vice versa. So, but now that the charter rates are high, and I'm assuming that we must be paying a premium to acquire the new vessels, sir, so how sound is this strategy? And sir, going forward, since everything is cyclical, then if next time when the charter rates go down, sir, will we not be stranded with high cost assets?
So, I would like to reply here that, the type of vessels that we operate are called multi-support vessels, right? And these are very highly specialized equipments with very limited number available globally. Just to give a broad, context here. So I am the only multi-support vessel owner, means with a fleet in India and the biggest in Asia Pacific. Means it is not up to me that, these vessels are readily available for purchase in the market. However, if I plan to construct a vessel, the minimum time that yard takes is almost 2.5 to 3 years to deliver a MSC fully constructed and new brand. So this charter hire cycle, as such, it is not fully dependent on the oil prices because this is towards the cost of extraction of oil, which is a continuous activity. Only thing is when the oil prices are higher, yes, the charter rates do increase, and when the oil prices are lower, they do decrease, but not in the same proportion. That is a very minimal impact. It is more about the type of services that we can provide with the vessels that we have in our hand. So what we have done, as I said, is that we have got a younger vessel. We have also shifted the type of service mix that we are providing as a service provider to our customers. And all these efforts have really resulted in increasing the charter rates. And we are very firmly, in belief that these kinds of charter rates will prevail for the upcoming next 4 or 5 years also. And maybe if we can further add more and more to our service, definitely we can also look at even higher rates.
Sir, so now, sir, let's assume that if oil prices, if they continue to go down, of which there is a fair chance of, let's say, going to somewhere around $50, so ONGC might not immediately cut its capex, but sir, globally the private players who are doing offshore activity, they might cut down on at least the offshore exploration part, Sir, all those surplus support vehicles might start bidding for ONGC tenders, resulting in lower charter hire rates, sir. So is that a possibility?
No, sir. Because when we talk of oil exploration, then we are talking about rigs. When we talk about, providing services to an oil field which is already extracting oil, then we talk of the diving support vessels, the offshore supply vessels, and all other things. So there is vast difference between the type of vessels which are used in oil exploration and the vessels which are used in providing services to the oil field which is already extracting oil. And once an oil field becomes operational, then what matters is the cost of extracting that oil, right? So whatever be the oil price, you don't stop extracting oil. As far as we are concerned, yes, we are fully occupied with ONGC, and with the limited assets that we have in our hand, we are only one of our assets is deployed with Aramco. Again, Aramco is such a big company that, thinking that when the oil prices will go down, they will stop extracting oil is not possible.
Sir, so one final question, sir. What is our strategy to acquire new vessels, sir? How do we determine that the price X that I am buying this new vessel for? So basically, what is the IRR that you are expecting when you are buying a new vessel?
So whenever we plan a new vessel, the age of the vessel as per the shipping norms is 25 years. In case of MSVs, it is even higher, right? So it has to be a match between the proposed charter where we are going to deploy the vessel, the time period of the charter versus the cost of acquisition. And suppose I get a charter of 3 years or 5 years, and I know that I am able to, almost get 50% of the total capex as a payback during this charter period, then I know that the value of the vessel left at the end of the contract with its remaining life is a very lucrative proposition. And that is how, in this industry, we all plan our capex.
Sir, so what would be the replacement cost of our existing fleet if we sell it in the market?
Replacement cost right now, there are at least 3 vessels which are quite old, and a typical new MSC, although it is far more superior with better equipment, upgraded equipment, and its capability to perform is almost 1.5 times of these old vessels. But that is right now the market is looking at almost like $100 million for a new vessel.
So since we are having old vessels, sir, how can we compare it with the new vessels, sir? We should, sir, I'm asking what is, if we sell all our 7 vessels today in the market, sir, what is the tentative price that we can get for them on as is where is current state, not the equivalent new vessel of same capacity?
May I answer, Rajivji?
Yeah, please.
Sir, this is a very theoretical question. Let me tell you. You remember there was a time when SEBI asked all the mutual funds that if you have to sell your portfolio, how much time you will liquidate, right? And people said 5 days, 10 days, 15 days. But you think that if all mutual fund comes and start selling stock, they'll be able to liquidate the stock in 5, 7 days, 10 days, 15 days. See, as Rajivji said, a new vessel takes around $100 million. Okay. Today, if you compare the entire fleet, theoretical value would be in the range of 1,500 to 1,800. But can I sell that all the fleet at one go? Not possible. Okay.
Okay, sir.
We are the buyer of fleet today. We are not the sellers of fleet.
Right, sir. And sir, lastly, sir, what would be the debt on our balance sheet on 31st March 2026? Net debt.
Net debt on 31st March 26 would be roughly about 300 to 400 crores.
Great, sir. Thank you very much.
Thank you.
Thank you. The next question comes from the line of Khushi Jain from Trident Asset Management. Please go ahead.
Thank you so much for the opportunity. So my first question is, you have taken the delivery of Seamec Augusta. Is the vessel already concentrated for work commenced from December 25? And basically, what is the day rate and constant contract duration for its initial deployment?
Vinay?
So, as per our budget proposal, this vessel is all scheduled to be deployed from December 25, and contract is in hand. Vessel will be deployed for next 4 years with ONGC through Hell Offshore, and its day rate is $25,000 per day.
Okay. And so how does its acquisition cost and expected return portfolio compare to the recent acquisition of Seamec Swordfish?
So see, the acquisition cost was $23 million, which is around 200 crores. And we have about minimum 8 years of life for the vessel. This is just the 8 years of life, while the practical life will be much higher. We expect the IRR to be upwards of 20%.
Okay, got it. So my next question is the MOU with the general shipping of 1,000 crore in capex is major commitment. So what is the specific allocation of this capital, sir?
So as Rajivji said, take on, please.
Okay. Thank you. Thank you, Sunil. So, we all know that recently the government of India had this maritime conference in Mumbai, and almost everyone in the industry participated in that. And because of the various benefits that has recently been announced by the government for the yards, with the shipbuilding yards, and for shipping industry as a whole, so, this becomes a very attractive for us also now to invest in new vessels. So maybe we are looking at a fleet of MSV, but we are also open now to look at the options of other vessels which can give us a similar payback. So that is why we were participants in this maritime conference, and we offered the government that we are ready to invest. We give a commitment to invest almost like 1,000 crores in capex over the next few years. And we have also given, all of us jointly have also given a memorandum of what is our further expectations from the ministry. And we are quite hopeful that the way government is responding so positively to the industry as a whole across various sectors, this shipping industry will also be a major beneficiary.
Okay, sir. So, what will be the expected saving for this spend over the coming years, and how it will be funded?
So as of now, it's a MOU that we have done with the government of India, and the timelines, the funding patterns, the exact number of vessels we are looking at, the type of vessels that we are looking at. So we are still in the preparation stage where we will prepare this complete project and then submit to the government, and it is under preparation at present.
Okay, got it, sir. Also, I have one more last question. So, sir, do you have any strategy to phase out older vessels over the next 5 years? As given these vessels are fully depreciated and have a low cash cost break-even.
No, that strategy is always there because our present fleet is now almost 10 to 11 vessels. In the last 4 years, we have bought 4 new vessels. We have discarded almost 1 old vessel. In the coming 5 years, definitely, if we are able to lay hands on new vessels, definitely we would like to upgrade the age of the fleet, because that is where then you start higher revenues, better margins and all those things. It becomes, and that is how you grow also. So these plans are always there. They are always under supervision, under working, that whenever we have an opportunity to buy a new vessel, we will definitely look at it.
Okay. So, how do you model the trade-off between high margin or fully depreciated assets and a high OpEx unavailability of an aging fleet?
No. So in India, basically, this leverage is not available to us because there are age norms, and DG Shipping is very firm about those age norms, that when the vessel crosses its age, it cannot continue to operate in Indian waters. So our total entire working is within the parameters of the various rules and regulations of DG Shipping, particularly regarding the age. So if in a vessel, this old vessel crosses that particular age, then I cannot operate. So that trade-off between buying a new vessel, and a lesser OpEx versus a vessel which is fully depreciated and a higher OpEx is actually not available to us.
Okay, sir. Got it. Thank you so much, and wish you all the best, sir.
Thank you.
Thank you. A request to all the participants, please restrict yourself to 2 questions only. Should you have a follow-up question, please rejoin the queue. The next question comes from the line of Aditya from Sarthak Securities. Please go ahead.
Yeah, thank you for the opportunity, sir. So I see that cumulative losses in overseas operations have reduced from 66 crore to 28 crore. So what is the any management approach plan to bring these subsidiaries into breakeven or even profitability? So if you could provide any milestones or timelines for that.
So see, we have been telling our investors in various previous calls that we are in continuous focus to ensure reduction in losses and profitable opportunities. This year, we believe that from 28 crore last year, we should be hardly 5-7 crores, and maybe in next year onwards, it should be break-even to positive.
Okay, got it. And the next one, the rationale for Seamec UK investments is to access the North Sea opportunities. So given the project is delayed by almost 10 years, 15 months, so what is the current expected ROIC for this venture, and how does it compare to the company's overall ROC target of 11%, you said?
Rajiv ji?
Can you please repeat the question? It was not audible to me.
Yeah. So the rationale for Seamec UK investments is to access the North Sea opportunity, right? So the project is delayed by almost 10 years, 15 months. So what is the current expected return on invested capital for this, and how does it compare to the company's overall ROC target of 11%?
So, this particular investment that we did in UK, so as of now, our plan is to make this office operational. Initial plan was to make this office operational by June 2026. And as of now, what we see is that we should be able to make it operational by September 2026. And this office will act like our license office for the Northern Europe offshore market. Because, sitting here in India with the asset in our hand, although they are fully deployed, but as we see, Northern Europe offshore market is a highly lucrative market in terms of charter hire rates. And this was in our plan. We have earlier ventured into Latin America, into US, into Middle East. And this is one market where we are very keen and eager because we are fully qualified. So by September 2026, we hope that this office will be operational. Not much of the major capex as of now is required for this project because of the total planned capex. We are almost over with 80% of the capex commitment and investment. Balance 20% also, at the end of the day, we might be able to, save something out of it. But that all depends on the pace of the work. So, fully committed to give you good news in the coming years.
Sure. Got it. And yeah, I think I will join the queue. Thank you so much.
Thank you. The next question comes from the line of Mohit Chandani from ValueWise Advisors. Please go ahead.
Hi, sir. Thank you for the opportunity. Am I audible?
Yes, please.
Yeah. So could you please reiterate the dry dock days for the ship, like which ones are coming in next year and then which ones are happening in FY27 and 28?
So for 26, our Seamec 3 and Seamec Princess both are slated for dry dock. And Seamec Paladin, we had planned earlier a dry dock somewhere in August 2025, but then we got an extension for 6 months, and this vessel is also going for dry dock at the end of January 2026. So these are the 3 vessels which are planned for dry dock in 2026. 27 and 28, we are looking at dry dock of Seamec 2, and we are looking at a very minimal dry dock for Seamec Anant being a new vessel. And we are also looking at dry dock for Swordfish and Nusantara. Nusantara will come at 2028 only. 27 is the balance of the vessels. This dry dock, happens after every 2.5 years and is typically a 90-day exercise.
Understood, sir. Understood. And could you please reiterate the day rates for Nusantara and Anant?
Vinay, please answer.
So, Nusantara, we are getting a day rate of $25,000 and Anant, this is agreed is $45,000. And both contracts are for 4 years with ONGC.
Understood, sir. And Seamec 2 is going off contract in January this year, right?
So, Seamec 2 contract got over by July 2025, but because of some dry dock days and off-hire days, this contract was renewed till Feb 26, but by the new DG shipping norm, remaining days will be over by August or September 2026. So it will work till August or September 26.
And post that, sir, will this vessel be available for hire, or since it is a very old vessel?
So we yet to firmly decide on that. Reason being, after 2026, to our understanding, the end situation would be DG shipping is allowing this vessel to work till 28. So we need to take a call after the contract gets over, looking at the working condition of the vessel, whether it would be feasible to put certain money on dry docking and again go for charter, or should we put it on stress. And this call yet to be decided. We are internally discussing and exploring various possibilities on that.
Got it. And are you in the market for new vessels?
Yes, we are exploring all possibilities for acquiring new vessel as well as old one. Whatever is the best suitable in the market, we are open for acquisition.
And by when can we expect new vessels to be announced?
This all depends when we get any good opportunity in the buying field. Whenever there is a good opportunity to acquire, we will let the market know.
Okay. Thank you, sir. That's it from my side.
Thank you. Ladies and gentlemen, in the interest of time, that was the last question. I would now like to hand the conference over to Mr. Bala Subramaniam for closing comments.
Thank you, Fatima. Thank you all participants. We conclude the call. Have a good day.
On behalf of Arihant Capital Markets, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you. Thanks everyone. Thanks.